All right, thank you everyone for attending. My name is Marco Rizzo Rossi. I'm the Executive Director for Washingtonians for Public Banking, and this is our final virtual town hall for the 2025 year. This series is we organized to help our members and supporters know more about the financial system, particularly public banking. Um, all our virtual town halls you can find on our YouTube channel and website. So if you're curious about finding more and you're impressed by the speaker today, you can look up our other ones at www.wa4publicbanking.org. Also, I want everyone to know that our upcoming biannual coalition meeting is going to be happening next month. For those who are interested, I'm putting the link in the chat for you to utilize. By attending this meeting, we'll review some of the things we've been working on the past year and what we are planning on for the next legislative session. Now, without further ado, I'm very excited to introduce our current speaker, who's going to be speaking on a very timely issue. We have for us today Professor Chris Peterson. Professor Peterson is the John J. Flynn Endowed Professor of Law at the University of Utah. Today, he's going to be presenting on the history of the Consumer Financial Protection Bureau and its future under the Trump administration. Um, Take it away, Professor Peterson.
Well, thank you so much for having me. It's nice to get to share some of my research and work, and it sounds like you've got a great nonprofit that's doing some interesting stuff up in Washington, and I'm happy to share some thoughts and maybe I'll set have a slide deck here. I'm going to try to set up in just a second, and then maybe at the end, if you want, we can have some questions and some dialogue because that might be a bit more fun than me joining on for too long. But let me see if I can get my slide deck to share. One second here. Can you guys help me out? Is that am I sharing my
Yeah,
slide
it's
deck?
it's good. We can see it.
Oh, fantastic. Thanks so much. All right. Well, uh one second here. So I guess the thing I want to start out with is just to kind of take a step back for a minute and remind ourselves, since it's you asked me to speak about the past, present, and future of the CFPB. There's a little bit of discussion of where the CFPB came from, and this is, I think, all general common knowledge, but it's a little bit easy as time goes on to get some distance from how serious things were back in the Great Recession. About seven, it depends on who you ask, and there are different estimates, but at least 7.3 million Americans lost their homes to foreclosure or short sales in the Great Recession. And that, when you think about the average size of a typical household, you're talking about the largest forced migration in the history of America, bigger than the Dust Bowl and the Great Recession, bigger than the Civil War. There's a lot of people who were not moving from one geographic area to another, but just all across the cities and rural communities across America. Millions and millions of families were being uprooted because they couldn't make their mortgage loan payments. And at the same time, the value of household wealth, nearly $11 trillion in household wealth vanished, both from declines in the stock market and people's retirement accounts, but also in the value of their homes, because so many millions of Americans, their home values were collapsing at the time, and that was their most important asset. And this had profound implications. I want to transition quickly to talk about the CFPB, but just a couple of quick things to remind ourselves of. There was a national spike in the suicide rate as so many people were facing the loss of their homes and the prospects of losing everything that they had worked in their adult lives to purchase. An increase in 13% increase in the number of people who took their own lives. And for children and for families that were struggling, there was a 35% increase in food insecurity in the country. People that couldn't, didn't have reliable, safe access to nutrition, and that can have devastating impacts, particularly on children who need reliable, safe, steady nutrition to grow. So, when we talk about what that means for our country, sometimes the consumer financial protection can seem like it's this sort of abstract thing that's, oh, are you going to have a fee on your credit card? No, it's much more fundamental and important than that. If people's basic financial lives are upset, it can have life and death consequences for millions of Americans. And Congress, I think, recognized that during the Obama administration. One of the marquee takeaway accomplishments of the Obama administration and the Congress at that time was the creation of this new agency, the youngest federal agency, the Consumer Financial Protection Bureau. It was adopted as part of many reforms in the Dodd-Frank Act, and that's what we're going to focus on today. And in particular, you've asked me to talk about what the future holds for the Consumer Financial Protection Bureau and maybe drawing some lessons from the past and increasing some awareness of what it has the potential, what it was, and maybe has the potential to again become. So obviously I'll talk about the CFPB's past, what's going on now, and maybe thinking about the future of it, and also maybe its place in our society and what a lot of people think may be a constitutional crisis that we could be facing in the coming years. So, just a little bit of background on the CFPB, and in particular, its enforcement office. I think so. One of the reasons I assume you asked me to talk about this is I worked at the CFPB back during the Obama administration, both in the enforcement office, which is the office that brings law enforcement cases against banks or other companies that may be violating the law. And also as a lawyer for the then director of the CFPB. At the time, it was a man named Richard Cordray, who was the Attorney General of Ohio before that. But the CFPB, it's responsible under the Dodd-Frank Act for enforcing a whole slew of federal consumer protection statutes that had evolved beginning in the 1960s, but all the way up until recent years. Things like the Truth in Lending Act that requires price disclosures on loans before you take them out. The Real Estate Settlement Procedures Act that prohibits kickbacks in the formation or in a buying or selling a home. Between the land the real estate agent and maybe a title insurance company or something along those lines. I'm just picking a few of these statutes out, but also the Fair Debt Collection Practices Act that has some basic minimum standards of civility and decency and the collection of debts by debt collection agencies. The Equal Credit Opportunity Act, a civil rights statute that prohibits discrimination against protected classes in the so including on the basis of race or sex or age, in whether or not people have a right to access credit cards or mortgage loans, etc. So those are just a handful of the statutes that the CFPB is responsible for interpreting in regulations and enforcing in law enforcement cases. And the CFPB this is an organization chart from the early
Oh,
years of the CFPB.
uh,
A little bit
Professor
hard.
Peterson,
Yeah,
just
go
real
ahead.
quick, it looks like your slide is still stuck on the first slide. We're not seeing if you're going
Oh,
through the different slides of your presentation, then we're not seeing them.
gotcha. Oh, I'm so glad you stopped because you
Yeah,
missed a whole bunch of really great slides.
yeah.
I was what I was afraid of. Hold on, let me
I was
see what
suspecting that was the case, but I was giving you the benefit of the doubt.
yeah, no, I
Yeah.
definitely was not. Sometimes so I've got like three different monitors on my desk here at work, and sometimes let's see. How about how about now? Is that better?
Yes, now we can see it.
Let's see. Well, thank you for stopping me, and sorry about that. So, there's a list of the statutes that I was talking about, and some statistics that I had gone through, but I'm not going to go back. So let's just jump ahead. This is a picture of the organization chart of the CFPB in the early years. This chart has been changed around a little bit by the different directors since then, but it's as good a place as any to kind of get a sense of what the CFPB was and has become. The CFPB has a bunch of functions. Just highlighting one here, the consumer response unit of the CFPB is Congress required the CFPB to create an intake portal to take complaints from the public about financial services that perhaps were not problems with people's financial services. And it's pretty innovative in some ways. It was staffed up to receive telephone calls from all people all across the country. Obviously one of the largest economy and one of the largest populations of a country in the world. And we had built an intake portal that was staffed up to receive complaints in about 180 different languages, and an online presence where you could just go on to the CFPB's website and complain about, a debt collection practice that was unfair. Your bank didn't credit a check that was deposited into your account. Those types of problems, and then the CFPB would forward those complaints to the financial services business and expect a response back to you and also to the government. And then we could use that to monitor whether or not there were hotspots in the economy where there were particular problems that were developing or challenges. And I think a lot of positive things happened out of that, just because the fact that the company knew that the CFPB was monitoring that made it more likely that those complaints would be responded to in perhaps a positive way for consumers. But it's not just that. There's also the CFPB designed offices that tried to provide an interface and provide feedback to a whole different variety of vulnerable or special constituencies, service members, older Americans, young people, students. And then also created offices to do research on the economy to make sure that we weren't ever surprised again, hopefully, with another impending financial crisis or breakdown in our financial services markets. And then offices to try to do bank audit financial services businesses to make sure that they're complying. And then, if not, potentially bring law enforcement cases and compel financial services businesses to provide refunds or damages to the public if they engaged in illegal practices. And that's the office that I helped design law enforcement cases back during the Obama administration. And here's a slide from a study that I did, about 4 or 5 years into the history of the CFPB that tracked how those enforcement cases were getting up and running in building a brand new enforcement agency. The blue bar charts, the blue bars show the number of public enforcement cases the CFPB brought, and the red line is the number of employees that the CFPB had hired in these different years. As the agency was ramping up, eventually getting to about 1,600 employees, 55 enforcement cases in 2015. Doesn't sound like that many cases, but as we dig in, you start to see a little bit about what that entailed. This chart shows a couple things: the total amount of relief awarded to consumers over the first 4 years or so of the life of the agency. In 2015, this shows that about $6 billion in refunds or restitution was provided to the public from CFPB's enforcement cases. And that's even though the agency, in terms of the federal government, is a relatively small agency. It's not like the Veterans Administration or the Department of Defense. They're really gigantic agencies that have tens of thousands, hundreds of thousands, in the case of the military, millions of people that work for them. The CFPB only had 1,500 people. That's smaller than a typical American high school. But that number of people, in simply enforcing the law, was able to return $6 billion in one year and redress to the public. And just thinking about that in terms of the number of employees that were working on law enforcement roles in the Bureau, this little line here shows the financial relief awarded to consumers per CFPB employee in its supervision and enforcement division. For every public employee hired to enforce the laws, about $9 million was returned to the public. So you hire a lawyer, some paralegals, some investigators, and for every one of them that we hired, they returned nearly $10 million in relief to the public that year alone. Well, and you could say, okay, I mean, you're giving back a lot of money to the public, but was that why? I mean, what is it? Was it just technicalities? What markets were they doing this in? Maybe a little drilling in a little bit more. 47 of the cases in the first about 5 years or so of the agency's life were about mortgage loans. Very much in the heartland of what the agency was supposed to do. Debt collection cases constitute about 29 cases, leading to about $6.5 billion in redress. Credit cards led to about $7 billion in redress, about 21 cases on credit cards. Extra add-on gimmicky kind of products like insurance products that maybe weren't very valuable accounted for about $2.4 billion in relief in 16 enforcement cases. And then debt relief agencies, student loans in the early years accounted for about $500 million in relief in about six enforcement cases. And what were they? What were these cases about? This slide, when one of my studies, I went and classified all the different legal claims that the CFPB's enforcement office was enforcing. Was it technicalities? Was it obscure rules? One of the laws that the CFPB enforces just says that in providing a financial service, you can't engage in a deceptive practice, which is something that's likely to mislead consumers who are acting reasonably. So you can't say false things to your customers. You can't lie to them in most colloquial terms. And it turns out that 73 of the CFPB's enforcement cases were going after companies that had said things that were not true to their customers. They were misleading the public about the nature of the bank account or the credit card or the mortgage loan or whatever it may have been. And that constituted about 10 billion. Those cases produced about $10 billion, which was about 93% of the relief that the agency provided to the public. So overwhelmingly, these were not cases that were brought on technicalities. These were cases where the law enforcement officials saw that the company was saying something that was false to their customers and went out and expected some accountability for not telling the truth to the public, which is something that I think that most of us could agree is not unreasonable. If we can have something that the government does, it's to expect honesty in the way that businesses deal with the public. Well, all of that started to change in the first Trump administration. In 2016, in the follow-on, in 2016 being the year that Trump was first elected, about 42 cases were cleared. 2017, it went down to 37, but by 2018, the number of cases that the Bureau was bringing had sort of fallen off to about the same as the very first few years of the Bureau. Only 11 enforcement cases in all of 2018. And looking back over those years, this chart looked at the number of cases that Director Cordray had brought, which was Obama's director, and then Mulvaney and Kraninger were the first and second directors under the first Trump administration, and the amount of relief that was being provided really started to fall off. It went from $11 billion in the Cordray years to 12 million dollars in the Kraninger era, she being the second director of the agency back during the first Trump administration. So a big drop off, but still, and I should also say too that in the later years of the first Trump administration, some of those cases started to pick back up, and they started to get some good cases. It's not like the agency it was in decline in some respects, but it didn't fall off a cliff. I mean, they were still doing their work. They still had a lot of employees that were doing the day-to-day work. And obviously, fast forward through the Biden administration, they're more aggressive. They got a lot done. A lot of interpretive rules saying, I had a very pro-consumer slant to them. There's a lot of discussion about that. But I want to turn it, if I can, to sort of move things along and fast forward to where the CFPB is maybe at today, and then think about next about what's going to happen in the future. Well, I think that today, I, you know, I think that the obvious takeaway for what's happening right now is that the CFPB is essentially been hamstrung. The agency has had a major shakeup in its leadership. As soon as the second Trump administration came in, they fired the then director of the agency, Rohit Chopra, and have not really had an actual confirmed director. Normally, the director of the agency is supposed to be nominated by the president and then confirmed by the Senate. They've never done that. Instead, they've had an acting director who is also works in the Office of Management and Budget in the White House. The Doge, team that was led by Elon Musk came in and attempted to lay off huge chunks of the agency's staff. That's been tied up in litigation. A federal district court judge for the District of Columbia put a stay on that, and then district of the DC Circuit reversed that say, and now the DC Circuit is thinking about whether or not they're gonna. I have to check in on where exactly the litigation is at, but they're likely going to have an en banc, meaning the entire DC Circuit, not just a panel, and eventually it's going to likely to make its way to the U.S. Supreme Court. We'll see, but what's essentially happened is that hundreds of CFPB employees have been frozen. They're not really doing the work of the agency. The number of enforcement cases has fallen off a cliff. I can also say from personal experience, at the time I was an expert witness hired by I won't talk about the particular details of the case, but I was an expert witness hired by the agency to look into some illegal practice or alleged illegal practices by a really high cost lender that was charging triple digit interest rates to its customers. The case was shut down. I was, summarily released from service, and it doesn't look as though there's any progress in that case. And dozens of other cases were just frozen. So alleged illegal practices with customers who are entitled under the law to refunds, all that's just been shut down. Many of those employees are still employed by the federal government because it's been tied up in litigation, but they're being paid, but they're not actually doing anything. So far from creating government efficiency, instead, the public is still paying these enforcers and regulators to just sit around their houses and not do anything. Many of them have also lost interest and moved on. And essentially, the agency has become inert. Well, why is it that that's happening? I mean, obviously, we all have our own political views on these things, and I don't want to be too political about it, but I do think that this is tied to some trends that are it's not just about the Trump administration, but about what's happening with respect to the public and our belief in our institutions and the ability of the government to solve problems. This slide that's up is a poll that showed confidence in national institutions among G7 countries. This is back in 2023, before the second Trump administration. You can see Canada had a 65 score. Among those G7 countries, we were dead last by a significant margin. People are losing faith in whether or not the country's leadership, the military, the judicial system, and the national government can solve problems and in the honesty of our elections. And going back to one of the things I talked about at the beginning of my talk, 1 in 4 Americans struggled to afford food in 2023, and that's likely gone up now as inflation continues to bear down on the public. We were nearly about a quarter of Americans felt like they did not have enough money to buy food. That's far in excess of any other G7 country. And the job approval rating of the U.S. Supreme Court has plummeted. Historically, one of the most popular branch of government, the most faith in the Supreme Court. That's now inverted. Only 41% of the public approves of how the Supreme Court is handling its job. And those with who have high personal trust, those with high personal trust have higher confidence in key leadership groups. But you can see that the confidence that people have in different organizations has really declined for elected officials and business leaders. Scientists still have the highest level of trust. The military is still trusted relatively. Interestingly, police officers still have more trust than some might suspect. People believe in their public schools, but what they are increasingly no longer have confidence in is our business leaders and elected officials. And it's interesting that both Republicans and Democrats share the opinion that partisans from the other party are generally bullies who want to impose their political beliefs on whom they disagree. Democrats think that overwhelmingly think that Republicans are bullies, and ironically, Republicans overwhelmingly think that Democrats are bullies. There's been a basic breakdown of trust across partisan lines in our society. And that's overall, that reflects just public trust in government overall. It's a little bit hard to see. It's a long-term slide starting in 1960, but you can see since the 60s, there's just been steadily eroding, a steady decline in public trust in government. And so I guess my point here is that yes, I mean there's a political back and forth. There's the problem of maybe the Trump administration isn't doing things the way that I might like or might not. They're not engaging in management of this agency in the way that I would hope for. But part of that is a symptom of our declining trust overall. It's not just about Trump, it's about whether or not we as a society believe that the government can solve problems. And how serious is this going to get? A University of Chicago Institute of Politics study in 2024 found that 28% of voters, including 37% who have guns in their home, agree that it may be necessary at some point soon for citizens to take up arms against the government. And obviously, that some of that's coming from the political right, but it's also coming from the political left as well. And 41% of likely US voters believe the country is likely to experience a second civil war. And that's the backdrop against which we have to think about where the CFPB is today. And, is that unrealistic? I mean, it doesn't seem that unrealistic if you think about what happened at the end of the last presidential election ago. Well, that's a bit about the CFPB's present and how it reflects where our country is at. It's a pretty gloomy message for people that believe that consumer protection is important and that faith in our government institutions to solve problems for ordinary working people is an important resource for our society. But what about the future? For that, I want to ask just a quick question about consumer protection law, which is what the CFPB and consumer protection law in general, and what it actually means. I wrote this slide actually for a keynote speech I gave to a group of law professors a little while ago who were thinking about what consumer protection law means, but I think it has relevance for your organization as well. Sometimes the people will say the conventional meaning of consumer protection law is it's laws that we use to try to protect consumers from inefficiencies or unfairness or injustice in the marketplace. Laws that try to right wrongs that have been done to people that are buying financial services or food or maybe even broadly speaking environmental or pollution protection from pollutions. That's the conventional meaning of the term consumer protection law. There's an ironic meaning that sometimes is bandied about amongst law professors, and that actually consumer protection law is often really to protect businesses from consumers, because so often consumer protection law has loopholes that design safe harbors for businesses to engage in practices that are really problematic. And actually, the consumer protection laws are there to protect the businesses from the consumers. It's an ironic and cynical view of what consumer protection law means. I think just thinking about the future, I'd like to suggest a third meaning, and it might be even maybe a constitutional meaning, a meaning of to think a way to think about consumer protection law is not just serving a function for the relationship between businesses and consumers, but something about what consumer protection law does in protecting our constitutional order in our society. And my view in particular is that an essential purpose of consumer protection law is to protect that constitutional order. One of the reasons that we have consumer protection law is to preserve the democratic order of our society. Why do I say that? Well, and I think for law professors, it's a little bit of an out there idea. But I guess I'm just going to have you focus for just a second on the preamble of our Constitution. Obviously, we the people of the United States, in order to form a more perfect union and establish justice. If the purpose of the Constitution, this is the very most basic, in some ways, it doesn't really come up in litigation that often because it's the preamble. It's not an operative section of the Constitution, arguably. But the purpose of the Constitution is to establish justice. Our society needs to have justice, and the laws that are produced through our Constitution are supposed to be providing justice to the public. That's the purpose of the Constitution. And ensure domestic tranquility, meaning that in people's domestic lives, we're not supposed to have a constitutional order that leads to or a system of government that has the kind of outcomes that we saw back in the Great Recession, where people don't have domestic tranquility if they are losing their homes and committing suicide. People don't have domestic tranquility if they don't have enough food to eat. And that's what we mean by the promotion of general welfare. The laws that our society produces needs to promote welfare for our public in a more general sense. And not just for us, but it's supposed to, liberty, having free markets is supposed to be something that provides blessings of liberty that can make our lives enriched and abundant and productive. That's what the Constitution is supposed to do. And the consumer protection laws, if they're not promoting that function, then people's faith in this Constitution is inevitably going to erode. And it's not just for us, it's also for our children and for the future. So I feel like the in some ways the inability of our constitutional order to promote consumer protections, a set of laws that governs the relationship between the public and all the businesses out there, whether that's financial businesses or Amazon.com or Walmart or all these big businesses that organize so much of our lives. Our inability to set out laws that where people feel like they are getting a fair deal, where they have the blessings of liberty for themselves and their children, are eroding our faith in the ability of our Constitution to organize our society. But it's not all bad news. If you think about what people want, consumer protection is overwhelmingly popular. Here's some polling from just about a year ago. Preventing creditors from taking action, such as filing lawsuits against consumers without clear evidence. That's overwhelming support. 81% of the public supports that. Protecting borrowers from abusive student loans and student loan servicers, 79% support, somewhat or strongly support that. Limiting the size and frequency of credit card late fees, 79% of the public strongly or somewhat support that idea. Limiting interest rates on payday and other high cost loans, 76%. That's a super majority of the public supports a speed limit on so to speak, on consumer credit. And closing loopholes that allow online or fintech companies to ignore consumer protections with new types of financial products. 73% of the public supports that. And they also support taking on discrimination by race and ethnicity in lending, overwhelmingly supportive of that, which I think in some ways is in this era where there's so much pushback on being woke or identity politics in some segments of our society. The polling suggests that even in that climate, people still support having fairness along racial lines in our financial services market. And so, I think that my I guess my point is that the work that you all are doing to try to promote a civil society that has access to safe financial products, the public supports that work, and supporting that is a way that we as a society can move forward to try to restore faith in our government institutions. I'm going to close now and maybe just open up for questions with a story about a client I had a couple of years ago. His name was Albert Nduli, and he was from Texas. It was a case I was hired to be, an expert witness in this case, and he was a refugee from Congo. But had been in the country legally for 20 years, something like that. And he worked as a security guard. His wife worked as a greeter or as a checkout or greeter at Walmart. And they had two kids who they were raising. They were living in relatively small apartment in Houston, Texas, and he had taken out a loan called a car title loan. I don't know if you guys have those up in Washington, but they're very common here in Utah and in a lot of countries, a lot of states around the country, including Texas. And this loan, it was a high interest rate loan, and it was a 6 month loan. The way it had an effective interest rate about, I want to say it was about 250% was what the interest rate was. So it's a very expensive loan. And he was making payments on this loan to the best that he could. The loan was secured by the family SUV. It was a big SUV. And they were using this to get him to work, to get his wife to work, and to get the two kids who were both going to community college at the time to their opportunities to get some education. Um, uh, and the loan had a 5 month duration. And he was making the payments. He missed a couple. He was a little bit late on a couple of them, but it's clear, even though this loan was a big chunk of this family's monthly budget, he was making those payments, doing everything he could to get them paid. But he didn't really understand the nature of the loan because the interest rate was so high. He was really effectively just paying interest on the loan. He wasn't retiring any of the principal balance of the loan. And then 5 months goes by, and the loan's about to expire, and he can either renew the loan, take out it and start all over for another 5 months, or he has to pay off the entire principal balance of the loan. And he didn't have the money to do that, and so the title lender decides they're gonna foreclose or repossess his car. And he didn't understand that's what was happening, that he's going to lose his car if he doesn't stay on this treadmill of debt. So one morning, 7:30 in the morning, he's getting breakfast for the kids. Everybody's getting ready to go to work and to school. They look at the window, and there's a tow truck out there to take away the sport utility vehicle. So he runs down to try to talk the repo guy into not taking his sport utility vehicle. And he's begging him. He says, "You can't take this. I've been making the payments. I'm working towards paying off this very expensive debt." And he doesn't understand that why they're doing this when he's still trying to make the payments. And so and his wife comes down. I think, still in their pajamas, and he gets his wife to go back up and get the checkbook to prove, or the bank account records to prove that they've been making the payments, to try to persuade this repossession guy not to take the car. But the repo guy's not hearing any of it. They get the car hooked up, and he's pulling out of the parking lot. And Mr. Nduli was running alongside the tow truck, begging the repo guy not to take this car, because if they don't have this car, he can't get to work. His wife can't get to work. There's very little public transportation that works and is functional for people in a busy life in Houston. And so if he loses this car, there's a chance they're going to lose their apartment. They could lose their jobs. This family is going to fall into crisis if he loses this vehicle. So he's running alongside the tow truck, begging this repossession guy not to take the car. And as the tow truck pulls out of the parking lot, Mr. Nduli trips and falls. And as the car is dragging along behind the tow truck, it pulls over his Mr. Nduli's head, crushes his head. And the tow truck driver pulls off to the side, realizes what's happened, and then just drives off and left him there. And then Mr. Nduli's wife comes down with proof that they've been trying to make the payments on the loan, to discover her husband with his head caved in the gutter outside of his home. That happened. That was a case that I worked on, and if I get a little bit sometimes hot-blooded, or if people tell me that I'm working on something that's too nerdy or whatever, I remember his case, and about how important it is for people to have basic decency in their financial services laws. The work that I'm doing and the work that I think many of you are doing and trying to fight for a more fair financial services system has life and death consequences, and it matters. And so, thank you for letting me join you and share a little bit about the past and the future of the CFPB. I leave that story because I don't know what the future is, but what I do know is that it matters. We as a civil society have to continue to fight to ensure that regular working people are treated fairly in the law and in our financial services industry. All right, well, I'll stop there. It was a bit heart-wrenching, but I want to hear from you all and hear what your reactions are, and if you have questions. It's a little bit awkward for me to sometimes speak in a Zoom meeting. Everybody's got their cameras off. I don't know if anybody's listening left yet, but if anybody wants to turn their cameras on and share a question or any feedback, I'd love to hear what you have to say as well.
Well, thank you, Professor Peterson, for an excellent presentation and a very concluding with a very moving story. I will invite everyone to have questions. If you want to ask a question, I just suggest that you use the raise hand function that you'll find in your Zoom. You can find it under the React feature, and I will call on them on the order that I see. Or you could also type your question or indicate that you want to ask a question in chat, and I will call on you. And I will say that, here in Washington, we also have title car loans. I believe they're heavily regulated, but we have those here in our state as well. So we kind of are also vulnerable to some of these injustices. But I'll leave it open up to anyone who would like to ask a question to Professor Peterson.
Don't be shy.
Yeah. Oh, I
I
have
actually do have a
Catherine. Catherine, go
question.
ahead.
Oh, I just want to say thank you for that presentation. And before I became a nurse, I used to work in banking, and that was a long time ago. And the interest rates were pretty heavily regulated because of usury laws.
Mhm.
So whatever happened to those?
Yeah, it's a great question. It's a long technical legal answer. Here's a short version of it. I mean, almost every state in the country had interest rate caps,
Mhm.
and they were a really, a useful tool. They could date back all the way to the founding of the republic. When we formed our country, all 13 original states had low interest rate caps. The big watershed moment was 1978 when the Supreme Court interpreted a Civil War era statute passed by Congress called the National Bank Act. And the Supreme Court held that if a bank is making a loan across state lines, which didn't really happen that much in the early years of the Republic, but when credit cards hit the market, became really common in the 1970s. It's the interest rate cap of the bank's home state that applies, not the consumer's home state. That's what the Supreme Court decided. And so immediately, Delaware and South Dakota eliminated their interest rate caps. My home state of Utah did it about a year or two later as well. And the purpose was to try to attract banking industry jobs to those states and then export the lack of an interest rate cap in Delaware, South Dakota, or Utah to every other state in the union, including Washington.
Mhm.
That only applied to banks, national banks. In 1980, in the Reagan administration, they modified that to apply to state chartered banks as well. And then that still didn't do much for non-bank companies. But as time has gone, like payday loan companies that don't have a bank charter. But as time has gone on, a lot of banks team up with financial technology companies, especially banks that are headquartered in my home state of Utah, a handful of other states. They team up with a fintech company and a bank, and the bank makes the loan on paper, but oftentimes oftentimes there's another company behind the scenes that's purchasing the loan back, doing a lot of the marketing, doing the operations. And so even one small bank can make it so the interest rates are functionally deregulated for lots and lots of people, even in states where the state legislature supports having an interest rate cap. I'm oversimplifying a little bit. Also, that's not true for military service members. The Military Lending Act provides an interest rate cap for active duty service members that applies everywhere and doesn't have a lot of exceptions. But usury laws have become a victim to, I think, interstate banking regulations. They've been pushed for years to try to get Congress to change all of that. It's gotten close a couple times, but they've never quite been able to get over the hump and actually get a law passed.
And before we take, we have some other questions. Before we take them, I know that not everyone who attends these is always familiar with all the jargon. So could you just explain what a fintech is for some people?
Oh,
I know
yeah, I'm sorry.
it's not as common as some of the other phrases that we have. So
Yeah, fintech, it's just become a hybrid of financial and technology. And it's basically refers to companies that are maybe have Silicon Valley IT sort of roots, but are engaged in financial services practices. So companies like Chime or Dave or Bridget, but also maybe sometimes people use it to refer to things like cryptocurrencies. And it's just as banking has become more and more focused on our smartphones and on digital services. Traditional old-fashioned banks or credit unions are kind of oftentimes, maybe not in alignment with some of the financial companies that are more smartphone native. So fintech is just a shorthand way of talking about, more digital banking companies.
and then next up, I have Glenn, and then I have Bruce.
Okay, thank you for allowing me to take a question here. Professor Peterson, thank you for your presentation. I really enjoyed it. Your comments around the importance of the Constitution, I think, just reinforced the need to have a social contract. I didn't mention, or you didn't mention that specific language, but I think that's what it speaks to. I guess my fundamental question is sort of a segue off of Catherine's. If if we agree that Project 2025 is going to be fully implemented, and we're going to be in a world in the near future that is basically going to deconstruct the federal administrative state. What what can we do at the state level to protect consumers? Because I guess there's an interplay between the consumer protection financial consumer financial protection board and maybe the AG's office, for example, in Washington State and other places. But what can we do to protect citizens from a lack of any sort of protection at the federal level?
Yeah, it's a great question. And also thank you for Glenn, I appreciate the point about the social contract. Yeah, it's right on point. I didn't say that, but it's actually exactly the kind of thing I'm talking about. Um, uh, yeah, your question about what can we do at the state level is a good one. These laws are still on the books. What has not happened is, I mean, all of this, all of the change at CFPB is just coming straight down from the White House. Well, most of it. Congress in the I can't even say the name of it. The big beautiful bill, this big bill they passed, it did decrease the total amount of money that the CFPB can have for funding its activities substantially, almost cut it in half. But they're not, it's the underlying laws that prohibit deception and financial services are still on the books. And at the state level, one of the innovations of the Dodd-Frank Act is that not only can it be enforced by the CFPB, it can also be enforced by state attorneys general and state banking regulators. And so the Washington Attorney General, in many ways, has as much authority to enforce the federal financial protection laws as the CFPB does. Now, maybe they don't have quite the same resources. One of the advantages that the CFPB had was a staff that's just entirely focused and dedicated to that, a bunch of economists and experts that were hired, had a lot of and a broad reach. You get a case done, it affects all 50 states, not just one. But Washington still has the power to enforce many of these laws. And my sense is that generally speaking, the Washington AG's office has been a pretty effective regulator and is to probably be applauded in comparison to a lot of other states. But I'm sure that they can still do more. And I think that they need public pressure from nonprofit organizations and from citizens to try to keep them focused on that mission.
Great. Thank you. And I will add before we hear from Bruce, here in our state, we have taken up some of the actions at the CFPB that the Trump administration has pulled back through our own state legislator to empower our regulatory agencies. But let's hear from Bruce. You have a question?
Yeah, hi Chris. Good to see you again.
Bruce, good to see you.
Yeah, Chris and I go back 20 years or so, back during the payday lending wars that I was heavily involved in Washington, and then I took a job at the CFEB. Uh, got to see Chris a number of times there too. So my question is kind of about the CFEB, but also about the importance of the lack of a CFEB during the explosion of AI. And I'm sure you've been thinking about that and the sort of what should we start being more aware of as AI has an increasing role in financial matters, and whether it's tenant screening or a payday loan or approving somebody for a home loan. I'm really fearful about the loss of the Bureau during this particular technological upheaval. So
Yeah.
I know I'm sure you've been thinking about that. So like
I
your,
have been thinking about it, and it's kind of it's a Bruce, it's a scary time. I mean, one you mentioned some things already. I mean, they may be using AI to try to do underwriting to figure out who gets a loan, and that may be excluding people from good credit. One of my big fears is that you combine machine-driven learning, artificial intelligence algorithms for figuring out how to predict what people will respond to with the massive increase in the availability of really granular, detailed financial information about people. So now a bunch of companies are getting consent to scrape or scan all of your day-to-day transactional data in your bank account. So they can see, what you're spending your money on, what day you're spending on, how much money's coming in, how much money's coming out. And then at the same time, they might be able to overlay that with things that are happening on social media. What you're clicking on, what kind of videos you're watching, what's happening, what are you doing on TikTok? Your online shopping behavior. What have you been searching for? And maybe add to that even gambling data, which is becoming a huge problem. So many, especially young men, are getting into sports betting, and all of this data that's out there. They may be able to design marketing procedures and tactics that really find people at their most vulnerable moments. After they lost a big bet, or when they've been looking at something online that maybe they can't really afford targeted marketing to them to try to get them to take out a loan that's not maybe in their best interests. Maybe if you are getting to the end of your paycheck and the most vulnerable moment for somebody is going to be that the Wednesday before their payday, when there's not enough food in the fridge and they don't have enough money to make ends meet, that's the time to target them with a advertisement for a triple digit interest rate loan. I mean, we don't even know. It's hard to imagine all the different uses for designing technology to reach people at their vulnerable moments. So, look, I'm not sure I'm saying anything that you haven't thought of either, Bruce, but not having a regulator that's holding companies to be responsible for honesty and basic fairness in their financial products when the capacity of financial businesses is growing so rapidly, it's a scary time. We need a Consumer Financial Protection Bureau to take on these challenges.
And the floor is open if anyone would like to ask any other questions. We have just a few minutes for maybe one or two more. Well, not seeing one, I will exercise my liberty as host to ask maybe perhaps the final question. We mentioned, in Washington State trying to take up this regulation, and where that some other states have tried to fill the gap that's been created by the pullback of the CFPZ. I think New York is doing some work, Illinois is doing some work. I'm wondering if you had any familiar with some things that are happening on the state level that is reassuring that states are stepping up to try to kind of fill this void.
That's a good question. I mean, I don't know it's directly on point, but I will say that I think there are areas where the red states and the blue states may find some areas to agree on. In my state in Utah, the Attorney General's office and the governor have been active in suing some of the social media companies for addictive and harmful marketing or providing products that are not serving young children well. And that my sense is that that's likely overwhelmingly popular in both blue states, and it's also popular in red states. There's the opportunity for us to come together to try to push back on the big technology businesses taking too much control of our lives. So that's something that's exciting to see. I think there's maybe opportunities for us to agree if we can put aside our toxic politics and try to find constructive ways to do good work together. Um, so that's just one example that comes to mind. On financial services, I mean, the other thing that surprises me is that it's often been the red states that have led the way in reestablishing traditional usury limits to the extent that they can for non-bank companies. Ballot measures in a whole handful of red states have passed in the past 10 years. In Montana, South Dakota, Colorado did it as well. They were a pretty probably purple, maybe lean blue a little bit, obviously now. But Arkansas all have interest rate caps, and I think that they're still viable in a lot of states. One of the things that slowed that down, I think, is just that it's so easy to circumvent them by using the banking laws. We need those states that stood up to the payday loan companies back in the payday loan wars that Bruce was just talking about a moment ago. We need that coalition to come together of both red state and blue state America to put pressure on Congress to act to try to stop the circumvention of those popular state interest rate caps. I'm not sure that was directly responsive, but a couple of things that I think are bright spots where maybe there's opportunities for bipartisan progress in not this year, but in the coming years.
All right. Well, we are at time, so I just wanted to thank Professor Peterson again for an excellent presentation. As I mentioned at the top of the hour, this presentation will go on our YouTube channel, which you can find access to through our website, which is www.wa4publicbanking.org. A link to the website is in the notes for the presentation that I just put up. So thank you again, Professor Peterson, for an excellent presentation. I hope everyone learned a lot. And please get on our newsletter and check out our website for future events for next year and beyond that we'll be hosting with as Washingtonians for Public Banking.
Thanks so much for having me.
Yeah.